So we talking about asset turnover. The reason why it brought us to all of these things is because of the analysis, because I'm going to be providing with some guidelines on the analysis, and that will now guide you or provide you with a blueprint to write your own analysis technically as we proceed with the discussion. So the asset turnover ratio, the asset turnover, ideally we expect it to be rising, we expect it to be higher, or we expect it to be greater. You see that I'm using the words. So it depends on the context you are in to decide which one to use. So ideally, it should be rising, it should be higher, or it should be greater. That is the ideal thing. So let's look at some of the circumstances or the scenarios relating to this one. So a higher ratio may indicate that number one, the entity is generating revenue. The entity is generating more revenue. That's the first thing. Now, remember the word we are saying here is may. May. The word we are using here is may. So number one, once we see that, oh, the asset turnover is rising, it means hooray, the entity is generating, may be generating more revenue. But that is not the only thing. Why will an entity generate more revenue? Because probably the entity's marketing campaign is yielding results. Okay, so number two, it could mean that the entity's marketing campaign is yielding results. So maybe the company is advertising on social media, on billboards, on Facebook, on radio, on TV, or whatever the heck, newspapers. Maybe it's bringing out the results. So yes, obviously they are generating revenue, but how are they generating revenue? Number one, it could be because the entity's marketing campaign, I didn't bring marketing, sorry. The entity's marketing campaign may be generating or yielding results. But not only that, number three, sometimes the entity may be generating more revenue because of flexibility in the credit policy of the company. Because of the flexibility in the company's credit policy. So number three, it could mean that the entity's credit policy is more flexible to allow for credit sales. It's more flexible to allow for credit sales. Please stay with me carefully. My phone got freezed. Where are we? Yeah, we are at asset turnover. We are looking at asset turnover. That's where we are at now. I don't know the time you went off. So the entity's credit policy is more flexible to allow for credit sales. But be careful. Before you make this statement, you have to look at the trade receivable days. So this statement to be confirmed using the trade receivable days ratio. Be careful, because you see, when you are analyzing, you don't just make vague statements. Your analysis should be authenticated. Your analysis should have evidence. Your analysis should be proved. So if you are saying that, oh, the entities generating more revenue because their credit policy is flexible, what is the trade receivable day? Now, if the trade receivable day period is also rising, then it means the credit policy of the company is favorable. That is why many of the sales or majority of the sales was actually a credit sales. So the entity is generating more revenue. It doesn't mean the entity is doing well. It simply means their credit policy is flexible because their trade receivable days is also rising or higher. But If they are generating more revenue and their trade receivable days is reducing or almost the same, then that is not the reason. Then you can't say the credit policy is more flexible, because if the credit policy is more flexible, they wouldn't have the same or a reducing trade receivable days. I hope you are getting the principle. So you don't just get up and make a statement about analysis of financial statements. The statement must be verified, proved, authenticated, generally. Or the fourth one. Maybe the entity is generating more revenue, or the asset turnover is rising, not because the entity is doing well, but because the capital employed of the company has reduced. So the entity's capital employed has reduced. Now, be mindful here, because this statement can also be confirmed using the movement in the capital employed. So don't make the statement vaguely. You have to look at the movement in capital employed. So to be confirmed using the movement in capital employed. Now, basic fraction, and you did this in KG2. Basic fraction tells you that when the denominator reduces, the result of the fraction goes up. When the denominator is less than the numerator, the results increases. So if the entity gets a higher asset turnover, it may not mean they are generating more revenue. It could mean the entity's capital employed has what? Reduced. Because when capital employed reduces, asset turnover goes up. So what am I trying to say? I'm saying that when you are interpreting the asset turnover ratio, these are the assumptions you can use to justify the movement in the asset turnover. It is either we are generating more revenue, true, or our marketing campaign is yielding results, true, or our credit policy is more flexible, true, or capital employed has reduced, also true. But you must verify, you must confirm it, not make vague statements. So the question we then ask ourselves is, how do we see that, like the fourth point, the movement in capital employed? What are some of the things that may indicate that, capital employed is reduced? How do you see that? Very simple. So capital employed may be reduced in the following ways. May be reduced in the following ways. In the following ways. Number one, maybe the company repaid some of its loans during the year. So repayment of loan notes or bank loans. I'll talk to you about capital employed in a moment, how we calculate it, but loans are part of capital employed. So if during the year the company repays some of its loan notes, then the capital employed has reduced during the year, which means the asset turnover could rise. That doesn't mean they did well in revenue generation. It just means there was a negative movement in capital employed. That's one of the reasons. Number two, if during the year the entity disposed some of its non-current assets. So disposal of non-current assets or maybe other operations of the business. That could be another reason, because if you sell your non-current assets or sell a division or a segment of the business, certainly their contribution to your revenue generation, it's not going to be there. Number 3, repurchases of shares. This is rare though, but if the stated capital or the equity capital is falling, that means there is a repurchase of shares. So if there is repurchases of shares, capital employed reduces. So that could be another reason in that particular case. Or during the year, the entity did a revaluation of assets. And for some reason, the assets suffered impairment. So if a revaluation was carried out and the assets suffered impairment, it means that your capital employed will reduce. All that I have said, the reverse is true. Don't ask me what it is. Go and write your own thing. The reverse is true.
Nhyira?
Yes.
I just joined though, my phone freeze, but I just joined. But what you are...
Go ahead. I don't know. I think your device is still messing you up, I guess, in that manner. Okay. I think your device is messing you up in that manner. So the reverse is true. What is the reverse? The reverse means if asset turnover is lower, reducing, falling, less than, it could mean the entity is not generating more revenue. It could mean their marketing campaign is not working well. It could mean they are not allowing credit sales, or it could mean their capital employed has increased. And when capital employed increase, what does that mean? It means probably the company issued more loan notes during the year, or the company acquired more assets during the year, or the company issued new shares during the year, or the company made a revaluation of assets, and that came about as upward revaluation of assets. That is why capital employed has gone up. The reverse is true. This is how you interpret asset turnover ratio. Any questions? Raise your hand, we'll bring you up, or you throw it in the chat for us. Can depreciation also affect the capital employed cost? The cost of sales will be reduced. Relax. In our formula for capital employed, cost of sales is not there.
No, the cost of the asset.
The what?
Cost of the asset.
When you say the cost of the asset, what do you mean?
Let's say you have the initial cost to be 20,000, then depreciation of 5,000. Now the net book value will be 15,000. So the asset figure will reduce.
Oh, okay. Depreciation policy. Yes, that could be something that will affect the capital employed. Definitely. We could say that. So the depreciation policy of the entity, or accounting policy, let's make it generic. Accounting policy for accounting for non-current assets could affect the capital employed. And I'm going to explain the accounting policy in a broader sense to you in a moment when we talk about the breakdown.
Let's come.
So the accounting policy is something that we can talk about. So it's true, depreciation can have an impact on the capital employed, because if during the year they charge more depreciation than they charged last year due to changes in accounting policies and estimates, then definitely the capital employed is going to be affected. Definitely the capital employed is going to be affected. Yes, Dixon, your hand is up. Yes, Sharifa.
By all these points, it means increase in liabilities and decrease in assets will turn the capital employed to be low.
Increase in liabilities.
Yes. Then decrease in assets.
No, capital employed, you will see capital employed in a moment, because liabilities are included in capital employed. So if one is increasing, the other is reducing, it's likely that the net effect will be zero. And I'm going to explain that to you in a moment. Then we see if it fits into your statement.
Okay.
All right.
I know capital employed is total asset minus total liabilities, right?
That is not the only way we calculate capital employed. So we will explain it in a moment, then you get a bigger picture. Okay.
Okay.
All right. Yes, Dixon, your hand is up. Yes, Dixon, your hand is up. Okay, so let me go then.
What I'm saying is that, you know, in other books, you'll find the formula not to be what you gave us, but it will be sales over the total assets. That is adding both the non-current and the current assets together. So I feel that what she wanted to say is stemming from the angle where the formula is not sales over capital employed, but sales over the total assets of the company. In that direction, then when the depreciation and the other things that affect the non-current assets, then it's going to affect the asset turnover ratio. I'm sure that is how it is, but I don't know which of the formulas we should stick with, whether this or the one at sales over total assets.
So I am teaching you what you have to take into the exam hall and what you have to stay with. Globally accepted formula for calculating asset turnover is sales over capital employed. If the question centered around calculating asset turnover using equity, then you can deal with issues relating to just shareholders fund or using the total assets. So if in the question the examiner says calculate asset turnover, then he puts into bracket revenue or sales over total assets, then you can use that formula.
Okay.
But if it is not given like that, this is the default formula for calculating asset turnover.
Okay. Okay. And I'm sure this is one of the limitations for this, because the formulas keep changing and you are not too sure.
It doesn't change. So that is why I will teach you what you have to know about generally.
Okay.
Do you get the idea? So I will teach you what you have to know about. If there is anything exceptional, it will directly be stated in the question, and then you will go by what has been stated in the question. If not, then we'll have to go with the default.
Okay, agreed. Agreed.
All right. So how do we then calculate capital employed? How do we calculate it? So like Sharifa mentioned, there are two ways it can be calculated, but she mentioned one. So let's look at it. So capital employed I think either formula gives the same answer. Not always, Maulawe. Not always. I'm going to explain that to you in a moment, so don't worry. Not always, because it depends on the context of the question. You realize that everything I'm saying, I'm talking about the context of the question, because there are sometimes the question will be structured in such a way that if you use the wrong formula, you get a wrong answer. You would think you've done the calculation, but it's wrong. So not always would the two formulas give us the same answer. So number one, we can say that capital employed, it's equal to total assets. Okay, let's pull up our currency sign. Less current liabilities. Total assets, less current liabilities. So that is the first way to calculate capital employed. This is the KG2 default way of calculating capital employed. Total assets minus current liabilities. But there is another way we can calculate capital employed, and I want you to stay with me on that way because usually the examiner will play on your intelligence on the second one. So in the second approach, we will say that capital employed will be equal to the shareholders fund plus long-term debts. Please note that the context of the long-term debts, you need to clarify that it is usually going to be interest-bearing debts. Interest-bearing debts. So note that usually things such as preference shares will be considered as debt, not as equity. So usually will be considered as debt because preference shareholders receive interest, not yes, even though we call it dividend, the dividend we pay to preference shareholders is treated in the P&L accounts, but dividend paid to equity shareholders is treated in the statement of changes in equity. So preference shareholders will be referred to as debt. So when we add these two guys up, it gives us the capital employed. But please stay with me carefully. Stay with me carefully. Note, number one, in some questions, the examiner will say that lease obligations, both current and non-current, should be included in capital employed. So you have to be careful. Again, it depends on the question. So if in the question there is lease obligation, by default, lease obligation is quote unquote not a debt, not a loan we've gone for. But when they are in the question, or when it is in the question, the examiner may say that the lease obligation should be treated as a long-term debt. So may be treated as long-term debt. So in that perspective, like Maulawe mentioned earlier, in that perspective, then if you use this formula, asset minus current liability, you get it wrong. Because the examiner said, let lease obligation be part of the long-term debt. So it means you then have to go with the second formula. Because if you go with the first one, you get a wrong answer. So it depends on the context of the question. It depends on the context of the question. Yes, Dixon, your hand is up.
Hello. Good morning.
Hey, am I safe? Okay. Oh. Then the second note I want you to take here is this. Is that when we say shareholders fund, we mean things belonging to the equity shareholders. So the shareholders fund will be made up of share capital, okay, share premium, if there is anything like that there, retained earnings, maybe some revaluation reserves. All these add up to what we call the shareholders fund. This is how we deal with capital employed. So the two formulas, quote or unquote, should give us the same answer, but it depends on the context of the question. If there is lease obligation or the examiner makes any classical or exclusive statement, then you have to go with the second formula, that is the formula on the right, and not the formula on the left, total assets minus current liabilities. If not, you will get it wrong because the answers will be different. That is the concept about capital employed, and that is the idea about asset turnover. Any questions, please? Yes,
Sir.
Your hand is up.
Yeah, sir, it's like the network disturbed me a little. I want you to throw more light on the lease obligation. Why you add it to the long-term debt? What about when you are calculating this in rules?
Yeah, so like I said, it depends on the context of the question. The examiner will tell you that, oh, for the purpose of calculating gearing, asset turnover, and liquidity, ROSI, lease obligation should be treated as long-term debt. the question will state it. So if the question states it like that, then you would have to include it in calculating your capital employed. That's the idea. So it has to be the question, and almost always all the questions that are available in terms of dealing with lease obligations, the examiner categorically states it in it. Now, what if the examiner is quiet, the 0.1% probability? What if the examiner is quiet? If the examiner is quiet, you can write down the assumption that it is being treated as long-term debt, or write down the assumption that it is not a long-term debt, and in either way, you'll be marked by the examiner correct. Are you okay with that? That's the idea about that. All right. So that is our first thing, asset turnover. Now, because you now have knowledge about this, it will make the rest of the ratios